All right, guys, welcome to our Friday night wealth creation course. This is Jerry Fetta, the owner of Wealth Dynamics. If you don't know me yet, that's totally my fault. I want to make sure that we do correct that error tonight. And we come to you live every Friday, 6 p.m. to talk about wealth. Okay, 6 p.m. Alaska time, that is 9 p.m. Central, 10 p.m. Eastern time. We know you guys are up watching Netflix and Hulu. You've been binging on Stranger Things. But we want to have you just take an hour of your time every Friday to tune in. Now, tonight we're talking about a really cool topic. We're going to talk about the 4 promises that can be made by the sacred account that cannot be made by any other investment out there. Okay, it doesn't matter whether it's real estate, stocks, bonds, mutual funds, it does not matter. Okay, now the last couple weeks we've been talking about legacy planning, putting money away from your kid for your kids. I almost said from your kids. In some cases, you do need to put money away from your kids. Investing, saving. And so tonight we're going to dive into really what makes the sacred account so great and what makes it so different. Okay. Now, I want to dive into a couple of basics here. Now, before we get into investing here, I want to talk about really what the sacred account is, so that way you guys kind of understand where we're coming from. So the sacred account is a high early cash value dividend paying whole life insurance policy. And it's used for accumulating and keeping your saved cash flow or your saved income for cash flow investments. So you're only investing in things that are going to pay an income. It's not for consumer spending. It's not for vacationing. It's not for buying a home. It's not for leasing a vehicle. It's for paying for something that's going to produce cash flow. That's it. And that's why we call it sacred. Its job is sacred. It's got one function. So this is really what we're looking at with investments. People invest all the time, whether it's intentional or unintentional, whether it's something you put away on your auto draft on a 401k, or you're saving up to put money into real estate. So here's what we're looking at with investments. Keep in mind the derivation of the word invest is to clothe your capital. So when you're investing, you're clothing your capital. You're putting money aside, and you're going to put that money into something. So when we look at clothing your capital, you have to look at what's associated with that. So with investments, the first thing every investment has is risk. Okay, so risk is defined as the chance of injury or loss. Okay, or it could be defined as a hazard or dangerous chance. So with any investing, you know that there's chance for loss. Okay, you have to look at that. The risk here is that you may lose your principal with investing. Okay, that's no matter the investment. So, Mike, for example, you've got real estate. Is there a chance you could lose your principal with real estate? You could sell for less than you bought for. Okay, and if you look at it from that standpoint, really there's some risk there that you could try and avoid by maybe putting money into a safer investment. And if you put it into a safer investment, it doesn't guarantee against loss. You still could lose money. Now, if you're in the markets, you're in mutual funds, ETFs, stocks, etc., the chance for a loss goes way up. Okay, way beyond real estate, because you're not tied to anything. So in an investment, when you're tied to something, sometimes that stabilizes the value. The example with Mike's real estate, it's tied to an asset. So within reasonable circumstances, as long as there's land there, as long as there's septic, intrinsic value, Mike's somehow going to retain part of his capital. It doesn't mean he's going to keep all the money he put into it. Now, the stock, there's nothing tying that to any sort of value. It can literally drop out the bottom and disappear, and that's it. Like, you don't have anything there. So realize risk is involved with investing. That's never going to go away. The next thing is investing has no guarantees. Okay, so a guarantee, and if it's a non-guarantee, it would mean no promise or assurance, especially one in writing, that something is of specified quality, content, benefit, etc., or that it would perform satisfactorily for a given length of time. So I know that's a lot. If we break that down, if you have no guarantee, it's saying that there's no promise of anything. So not only with most investments, not only are you risking your capital, but there's no promise you're going to make money. A lot of investments, they actually disclose to you, hey, you're probably going to lose money if you do this. So there's no guarantee you're going to make money. Now, in addition to that, especially in writing, you guys see this specifically. If you're in Wall Street, I was for a number of years, you are not allowed to put in writing any form of guarantee. Okay, if you wrote to the client that you could guarantee a return or guarantee that their money's protected, like, that's a way that you get your license taken away and kicked out of the industry. So there's no guarantee of anything. All right. And then also, there's no guarantee that the investment will perform satisfactorily for a given length of time. So even if you show like a hypothetical, you guys know what a hypothetical is? So with mutual funds, when somebody's selling like a fund or a stock, they'll pull up like the last 10 years or 20 years or 30 years of track record. And they'll say, and we'll look at some hypotheticals tonight, but they'll say, hey, look what the investment's done. And they'll try and sell that as a reason why the investment's a good idea. So let's say over the last 20 years, this has averaged 12%. And as an investor, like Nano, when you hear that, what do you think as a consumer?
As a consumer that does not know what average means, sounds good.
Yeah, it sounds good. It sounds like, man, this thing's performed, and that means it's going to do 12% again. Okay. Now, this is the disclosure I had to memorize. Past performance does not guarantee future results. You guys heard that before? Okay. In the industry, when you're in Wall Street, they make you drill that thing. Past performance is not an indicator of future results. Past performance does not guarantee future results. Anytime you see that on a hypothetical, literally the bottom of every single page says that. So they're showing you like made up numbers of something that it did in the past, knowing it's not going to happen again in the future. Just because it did it before doesn't mean it'll continue doing it. That's an important thing to remember. A lot of times investments are sold on this thing's performed so well, and because it's performed so well, you should put money into it. And people usually will. Like that's usually the number one reason why somebody does invest is they say, oh, this did well. Okay. So with any investment, you have risk. There's no guarantees. And then with any investment, there are typically going to be taxes at some point. All right. Mike, do you know what the definition of taxes are?
Not the true definition.
Theft.
Well.
So this is the true definition on the dictionary.com app. Taxes are a sum of money demanded by a government, that's a good word, by a government for its support or for specific facilities or services levied upon incomes, property, sales, etc. So that's taxes. So if you invest, Mike, if you invest with, let's say, one of your properties and you have positive cash flow, you're going to pay taxes on that?
Yes.
Okay. Nano, if you invest in a stock and you sell it at a higher value than you bought it, are you going to pay taxes? Okay. So I actually had a client text me, I think it was the day before yesterday, and he's like, hey, I threw down some money in a deal, held it for 3 years. I made some great cash on it. It's just now coming to maturity. I'm getting my funds back, and I'm being hit with capital gains tax. Okay, capital gains tax for this guy means 20%. So 20% of everything he made is going to go to taxes. All right, if you've got earned income from an investment where it's interest income, including your bank account, that's taxable as income. If your bank has paid you, I think the number is $10. If your bank has paid you more than $10 in interest, you have to report that and pay taxes on your income. So you will pay taxes with almost every investment. Okay, there's not really a way around that. Even if you've got a 401k, when you pull the money out, you're going to pay the taxes then. Taxes are unavoidable. So this is just kind of one of those things with investing that people don't really consider. They just think about the return, right? So we go back to that 12% example. Nano, if you're a consumer and you're here 12, are you thinking 12 before taxes or after taxes? Or are you thinking about it at all?
I just think 12 is better than 4 or 6 or 8.
Yeah, there's no thought about, all right, well, am I going to keep the 12? Okay, 12 could be 9 because you get taxes on it. So that's something that you've got to really consider. Every investment out there, for the most part, is going to have some sort of tax, whether that be income tax or whether that be a capital gains tax when you sell it and you make money on that deal. So this is like 3 of the realities of investing. One of the 4th ones here is legacy, and this is kind of cut off, but legacy is a gift of property, especially personal property, as money by a will, or it could be a bequest. So if you think about, again, back to like risks, not having guarantees, if you have money put away, invested, and you die, even before you die, there's no guarantee that that money is going to outlast you, right? Depending on market conditions or volatility or fees or performance, like you could basically outlive your money where you run out. Okay, the second thing here is, even if you had that money left over, if you pass that on to your kids or grandkids, there's no guarantee that they're going to be good stewards of it. There's no guarantee they're going to use it correctly. So you could do all this work to build up all of this wealth, and then you have all these great investments, but you pass it on to your kids and they're dinguses and they don't know how to use it and they waste it all. No, you're not around to stop them. So you're hoping like, hey, I'm going to put away, millions, and I hope they do the right thing with it when they get it. If you're the average person and you don't have a plan in place for that. So that's the other thing, is legacy is not guaranteed. Investments are not guaranteed to survive you. And if they do, it's not guaranteed that your beneficiaries, your heirs, are going to do a good job with those investments. So I want to hit that again. We have risk, we have no guarantees, we have taxes, and then we have legacy risk as well. And that's a reality with any investment you're going to do. It doesn't matter whether that be real estate, stocks, mutual funds, ETFs, doesn't matter. Those are all part of investing. Okay. So reward versus risk. This is the other thing I want to talk about really quick. So when you invest, there are basically only ever 3 rewards. Okay. I could make income. I could have capital gains, meaning I sell it and I made money, or I could have a tax benefit. Those are the only 3 rewards with investing. Can you guys think of more than that? Pretty much just those 3, right? So I could have income, I could have a capital gain, or I could have a tax benefit. Now, as far as risks are concerned, there's always more risk than there is reward. Okay, so the risks are you could lose principal. Okay, you could have underperforming returns. There could be tax liabilities with the investment. Like we talked about with the legacy thing, there could be survivorship liabilities, reduction of purchasing power due to inflation, risk of time invested. And I put an asterisk next to this one because people don't think about this. Risk of time invested means that it took me time out of my day or out of my life to manage this investment. So when people invest, like you look at, how distant can I be from the investment? Okay, Mike, what are some things you've learned with fourplex investing? Should we even call it investing anymore?
No, it's
just fourplex jobs.
fourplex jobs. Yeah.
What have you learned with fourplex jobs?
I mean, I knew it was gonna be a lot of work because it's like you're a landlord, right? But the idea is just like once you know how much you're worth and you go do the job that you're still responsible for and liable for, then you're like, why am I in this job?
Yeah.
I can't quit the job, unfortunately. Not right away.
And you can't get fired either.
Nope. It's like a job that
prison.
Prison, yeah.
Yeah.
Locked up.
So that's risk of time invested. It means I bought an investment, I didn't think it through, and it takes my time and the amount of time, like Mike said, what's my time worth? So the amount of time involved outweighs what the investment pays. So let's say when Mike's producing, let's say Mike's worth $250 an hour. Okay, if Mike's really like closing deals, producing, building his business, what's normal for you on cash flow with a fourplex?
$200 for the month.
Okay, so that means that Mike has 1 hour. If Mike spends more than 1 hour, that's now a loss because it took 1 hour of Mike's time, and Mike's time is worth $250. So as soon as it's taking more than an hour of Mike's time, it's no longer an investment. Mike bought a job. That's how it works. So that's the risk of time invested. And the inverse of that statement, it's called return on time invested. So if you think about the, return on time invested, if I'm going to put time into something, I want it to be like a gigantic return because I can't get the time back. Right. So Nano, you've seen kind of return on time invested. Some activities you kill it, like, you make 10 grand in one call, right? Or some activities, it's like, I'm not going to make anything, but I'm waiting for the one that does pay. And that's return on time invested. If Nano could choose, he would only have the $10,000 activities. Yes. Just line the schedule up with them, right? So that's return on time invested. And then the next one here is risk of time horizon. So risk of time horizon means how long are you stuck in the deal? That's a risk. Okay, and that could be opportunity risk, meaning that, I had another deal that came up and I couldn't do it because my money was locked up. So that's opportunity risk. Or it could be something happened and I needed that money. I couldn't get to it because it was tied up in a deal. So like back to like the fourplex thing, Mike, for your fourplex, if you have equity available and an emergency comes up, how easy is it for you to grab the equity out of the fourplex? Difficult. So that's like probably not reliable, right?
It's like getting another mortgage.
So you got to qualify. You might as well use a credit card or use cash or borrow money because you're not going to pull that out of the deal. So that's the risk of the time horizon is if you have an emergency and you do need that cash, you're probably not going to be able to access it if you don't have the right time horizon on that money. So then there's also like liquidity risk. Like there's so many different risks for the trade-off of basically 3 potential returns. I might make income, I might make a capital gain, I might get a tax benefit. Okay, so when you start to stack these up, it really kind of makes you take a second thought at investing, right? It's not just like, yippee, let's jump into it. It's like, hang on, there's only 3 good things that could happen, and there's like 12 bad things that could happen. So from a pros and cons list, like you have to really slow down and look at investing and think about, all right, how can I secure these things and how can I eliminate these things? Okay, you guys know Warren Buffett's #1 rule of investing?
Never lose money.
Never lose money. Rule number 2 is never forget rule number 1. So Warren is telling you, you need to get rid of this and you need to figure out, how do I get these things to always happen 100% of the time?
But Warren Buffett invested in stocks.
I mean, he's a market maker. It's a little different than your piddly index fund that you put money into. So this is the reward versus risk thing. And that's where, like, if you're an eager investor, this course is perfect for you tonight. If you're an eager investor, meaning you just can't wait to pop your cherry with an investment and stick whatever little money you have into it and try and make money off of it, that's how poor people think. Okay, think about it. If you're poor, your MO is, how do I get as much as possible in exchange for as little as possible? Okay, how do I barely not steal? Like, I want to put no money into the deal, but I want all the cash flow and I want it to be great and I want it to grow. That doesn't exist. So you have to really look at, if I've got money to try and get these things and I put it at risk, I'm making different decisions when I really confront the risks. And the example can look like this. If you're a $50,000 investor, or let's say even bigger, let's say $100,000 investor versus a $5,000 investor. Okay. Nano, if you had 100K versus 5K, which one are you more careful with?
100K, that's for sure.
Okay, if you're looking at investments, which one are you going to be more hesitant to put money into the deal with? 100K. Why is that?
More money. So more time to make it.
More time, more effort. Nano's going to remember every single phone call he made to get there. Now, 5K, have you lost 5K before or spent it on something stupid?
Yes.
Okay, do you even care at this point?
Not anymore.
Okay, so 5K, Nano's like, I could lose it. I'll get it back. I've done it before. It's not a big deal. 100K, Nano's like, all right, this is more money than I've ever had. I better make sure I make money with this thing, because it's going to take however much time it took Nano to get there to get it back if he loses it. So that's a critical thing. If you're this investor where you're investing with nothing, you're literally investing with pocket change. Like, you could literally find that money on the side of the road. Like, that's not an investment. So if you're being pitched $50 in your mutual fund, think about, like, that's not worth doing. There's no consideration of risk. You're literally like hoping you win the lottery. That's what you're doing at that point. So reward versus risk is huge. Now, I want to dive into the second segment of tonight, which is the actual sacred account, the guarantees and promises that the sacred account can make that nobody else can make. So the first one is this: you will never lose money with the sacred account. Now, I know that's hard to believe, but think of it like this. If you think of the sacred account, never lose money, immediately, like when you hear that, Nano, what do you think? If you didn't know anything about the sacred account, I was like, hey, I guarantee you'll never lose money.
Yeah.
Sounds like a scam.
Well, what's the catch?
What's the catch? Or I think of maybe like a bank where I'm like, well, duh, but it's not going to grow. Like, of course, you could bury it in the backyard and never lose money. It's not going to grow. So there's things that come to mind. None of them are, man, that sounds like I'm going to make a bunch of money with it. It sounds like scam, not going to work, really won't grow. It's safe, but it doesn't have any potential. So with the sacred account, we can say you will never lose money. Like I mentioned, the sacred account, it is a high early cash value dividend paying whole life insurance policy. That's where you're putting the money into. The reasons why we can say you never lose money is life insurance companies must maintain a government mandated reserve requirement. So when you think of like a bank, when you give $1 to a bank, that bank loans your dollar out 10 times on the dollar, which means their reserve requirement is 10 cents for every dollar you gave them. Okay, with life insurance companies, they're required to set aside a portion of their revenue to meet the reserve requirements. And then on average, typically what you're hearing in the industry is 5 to 1. So for every $1 you gave them, they have 5. So they've got liquidity, they've got, protection. So there's basically a 5 to 1 ratio on all of your money. And you'll kind of see when we go through the numbers here on the actual asset positions of these insurance companies. Now, the average company we work with, they have in reserves, not in assets, just in reserves, usually around $20 billion. So think about how much, just $1 million would be. Okay, now if you think about how much $1 billion would be, now do 20 of those. Just chilling, waiting. Like if you need it, and the reason why is they have to think about what if policy loans come out? What if death claims have to get paid? Their reputation is based on how well they pay. So if they can't pay a death claim because they didn't have money set aside, then it really kills their reputation. They're going to start losing business. So it's in their best interest to be able to have that money set aside. So they have to maintain a reserve requirement. It's mandated. If they don't do that, they can no longer remain an insurer. They can't keep doing business. And then on average, this is around what they have in reserves. Now, the cash value in a life insurance policy is also insured at the state level. Every state has what's called the State Guarantee Association, and it's different per state, but every state basically is insuring the policy. If the company goes insolvent, the state comes in and they reimburse whatever you lost. Okay, now that's the last one I like to rely on because it's government based. I don't like to rely on the government for anything, so I would much rather rely on a high reserve level, $20 billion in reserves, and a high revenue and profit margin as well. I know a profitable company will always do better than a government will. That's going to be better for me as a policyholder and as an investor. All right. Now, I want you to think about with your mutual fund, how much money do they have in reserves? None. It's all invested. It wouldn't be a fund if it was just sitting there in cash. So if they don't have that money in reserves and something bad happens, that's why it reflects in your share price going down. They lost money. They're not required to recuperate it or do anything for you. It just means you went down in value. Same thing with real estate. Now, when you buy real estate, they do typically make you hold reserves. What is it? 6 months?
6 months.
6 months of reserve. So at least with real estate, the bank understands we're lending you money. You better be able to pay the mortgage. You need to have 6 months set aside before we give you a dime. Okay. So that's the reserves. Now, the other thing that guarantees you would never lose money, and this is so far talking about market volatility and risk, but life insurance is also protected from creditors and the IRS. So you could lose money on, let's say it's real estate. Mike, if one of your tenants sued you and won, could they take your property? They could. So even then, like there's some liability there, even though it's a more secure asset, right? Or let's say, like a Ponzi scheme is going on. You've got money in a mutual fund and the mutual fund gets in trouble. And it turns out the entire thing was illegal and that like the fund gets taken over and seized by the government. You're no longer liquid. You don't get your money back. That could happen. So the sacred account is protected from creditors, meaning, if I go bankrupt, they can't touch my sacred account. If I owe debt, they can't collect on my sacred account. Same thing with the IRS. The IRS can't try and levy my sacred account. They can't try and tax it. Like it's a unilateral contract, meaning there's only one party to the contract. So I'm the only one that is control, which is huge. In a bank, you've got the bank that's in control. They can let the IRS in. They can let your creditors in. They can do so many different things to give access to your money without you ever having that control. And really, like it's open-ended. Same thing with a mutual fund company. Like I heard a guy, I was meeting with him the other day and he was telling me, and I want to sketch this out for you guys can see it. He was telling me about a deal he helped put together for one of his clients. So we have the client over here. And the client wanted $10 million. And he didn't want any of his own money going into the $10 million to get it. So check this out. We have $10 million. This money is inside of a trust. This is a real life thing that actually happened. The client, he's got some of his own money already in the trust, but he's like, hey guys, I want to put another 10 million in it. I don't want any of that money to be my own. I'm not putting a dime out of my own pocket. So what does he do? He does two things. He basically goes to, I think it was Goldman Sachs, and he borrows $10 million from them. Okay, now he's got $10 million. So far, pretty easy to track, right? Goldman Sachs knows that they would rather have the money up front than collect interest payments from this guy. So they're like, hey, let's say he's paying 3% on this debt. They don't want the 3% cash flow. They want to get in advance on that. So what they did is they took this $10 million debt that they are owed by this guy's trust, and they sold it to a mutual fund company. So they said, guys, we have investment grade debt. It's paying this return. We'll sell it to you, and you have to pay us this much in profit. So they basically cash out and they make profit. Now, the mutual fund company, they also don't want the debt. They would rather have the money today. So the mutual fund company, they put it into a money market fund where it is sold off to investors. So the mutual fund company does the same thing Goldman Sachs does. They say, well, we don't want 3% interest. We want money today. We're going to sell it to a bunch of naive public investors that don't know what they're doing, even though we already bought it from these guys, and it's just money they loaned to this random guy in a trust. So all of these people are putting money into the money market thinking like, oh, I'm earning, 2% or 3%, not realizing it's backed by nothing. And this client, what did he back it with? He backed it with a sacred account. So he bought a life insurance policy for $10 million, used the money that he borrowed to fund the life insurance policy so that when he dies, the policy pays this all off and the 10 million goes into the trust. Literally, there was no money backing any of this though. Think about that. These people here, they think that they bought an investment. They bought literally nothing. The money was created out of thin air, sold once, sold again, and then sold to them. Backed by nothing and a life insurance policy. Isn't that crazy? So my point with that, guys, is when you think like when you think your money is secure and safe, like you really have to understand where it comes from. Where is that money coming from? Where did it originate from? How did it get here? Who's making money off of it? How many times has it been bought and sold? And you don't know any of that stuff with a mutual fund. Okay, so with the sacred account, that's the way we guarantee you never lose money. Again, we have companies that have to maintain reserve ratios. On average, it's $20 billion just sitting in reserves. Typically $5 that they have for every $1 you gave them. And then you do have, again, state insurance on it. And then you do have protection from creditors in the IRS. So those are the ways that we guarantee the sacred account will never lose money. Now, the next guarantee we have is this. About to get even crazier. We guarantee you will make money. No matter what, you'll make money. Okay, now here's how we do that. So our average sacred account partner, the companies we work with, they've paid dividends for over 150 years in a row. So think about the consistency there. Now, we're not saying because they've paid 150 years in a row, they're going to continue to. We're just looking at it and saying they've paid for 150 years in a row. Now, if you have a company that's paid dividends for 150 years in a row, that means they were profitable for 150 years in a row. So if they've been profitable for 150 years, meaning they're cash flowing, they're maintaining a high reserve requirement, they've got $20 billion in reserves. You'll see what they have in total assets here in a second. Based on math, Nano, what would you say about that company?
Pretty solid.
Pretty solid. Every single year, they're setting aside money and they're profitable. They've got $20 billion just sitting there just in case, and they have to save a percentage of all their income. Now, that sounds awfully familiar, like what we teach our clients to do. Make a bunch of money, keep a percentage of it aside, fill your sacred account up so that when you find the right opportunity, you're ready. They're following that rule. And the reason they're following that rule is I had a client ask me this the other day. He's like, we're talking about the top 1%. He's like, well, where are these companies in the top 1%? And I was like, so there's a list, and we'll go over this. It's called the Fortune 500. So you've got the top 1% of people. The Fortune 500 is the top 500 corporations in the country. Every single sacred account company we work with is in the Fortune 500. So what that means is they run the top 1%. Like they're so far beyond just being an individual with 1% wealth. And you're going to see this in a second. Like the money that these companies have put away makes Warren Buffett look like pennies. It makes Bezos look like nothing. Like Bezos doesn't even have half of what the companies have set aside just in assets. Not like total everything. It's just this is what they've got set aside. So this is what we're looking at, the consistency over the time period. And this is average. Our longest company has paid for over 170 years in a row. So one of our sacred account companies, every single year, 170 years in a row, they've paid a dividend consistently. Like, that's super amazing. That's incredible to see a return like that. We've talked about compounding interest. Okay, compounding interest, like we've mentioned in previous courses, doesn't work if you lose money. You can do 10%, 10%, 10%, 10%, and if you lose money once, that compounding cycle has been interrupted. It no longer is compounding interest. So literally, the only way for compounding interest to work is for you to make money every single year and never lose that money. And by doing that, you actually have compounding interest. Otherwise, you've got volatility. Think about, like, if you do just on like a calculator, just to show you guys. So if I have 5 times 10, it's 50. Positive, right? So that's compounding. But if I have 5 times a negative 10, I've got negative 50. 5 times negative 10. So when you think percentage is multiplying off each other, when you multiply a positive percentage off a negative balance, it's still lower than what you had. And if you multiply a negative percentage off a positive balance, what do you have there, Mike? Nothing. A negative percentage off a positive balance, it's a loss. You lost money. There's no return there. So in order for you to even have compounding interest, you have to have a situation like this. Without the sacred account, you really don't have investments that truly have compounding interest, because there's not other investments out there that have 150 years in a row, 170 years in a row of track record. All right. Now, they do have a 4% minimum guarantee. Now, people have asked me, where does the 4% number come from? So every year, the life insurance company does just like any business, they do their business planning. They sit down, they look at what they're going to have coming in, what their projected growth is going to be, what they expect in profitability. And they know for a fact that they're going to have that margin because every single year they're collecting premiums. So they have income they can rely on. It's no different than you having a salary. You know, all right, I got $6,000 coming in this month. I know I'll be able to save this. It's not like commission where it's up and down. Think about like how much money they've been in business over 170 years. How much money do they have residually coming in every single month in premiums, where they know it's coming in, they know they're going to have revenue, they know they're going to have profit. So they can very confidently predict their profit margins, and that's how they can guarantee that dividend. Now, the other thing they can do to have profit is lower expenses. So the companies are lowering expenses, bumping up the income, making sure they have margin. So these are not like small cap companies that are trying to blow up like Amazon. They're already that big. They're trying to build more and more solvency and invest more and more and compound more and more. They're not looking at how do we start the next company that blows up. Like, these guys have been in business since the Civil War and they've been winning ever since. So their mindset is a little bit different. Now, the minimum guaranteed dividend is 4%, but the average has actually outperformed that. It's actually done better. It's done 6 to 8. So what does that tell you, Nano, as an investor? If I'm like, hey, Nano, our minimum guarantee is 4, but over the last century and a half, we've done 6 to 8.
Solid.
Are you really worried about the 4 at that point?
No.
Not really. You're like, all right, cool. You guys have doubled it every single year. That's pretty good. Okay. So the performance has been higher than that on average. And again, the reason why is their business model. Consistent residual revenue. Okay, so if a client is putting, $5,000 a month into the sacred account, that means that the company is receiving $5,000 a month. That's revenue that's coming in the doors. They know that money is coming in. So think about how many clients do they have globally that pay them premiums. And then with the cash values, the reason they can pay a dividend is they invest money. They grow the money, they increase the income, they invest it, they multiply it so that they can have those profit margins and spreads. Every single year they have that. Another income source they have is the loan interest. When policyholders pay loan interest, they know, all right, we've got this much in borrowed cash value. We'll have this much in interest coming in off that cash value. We know that this is the money we're going to receive. So they have a very consistent revenue model. And then really, like with insurance companies, when you dive deep into their books and balance sheets, which anyone can do, you can go on Northwestern's mutual website, Guardians, Mass, New York Life. All of them post their books. So you can literally find out like what are their holdings, what do their balance sheets look like, what are the cash flow statements. All of that's public information, and they update it once a year. Okay, so you're able to see all of that information. And what you'll realize is most insurance companies are actually what's called a conglomerate. Okay, anyone know what a conglomerate is?
Like a group of some sort.
Like a group. Mike, you look like you might think you know.
Well, it's like I think it's several businesses working together to create profits.
Yeah,
Mastermind.
under one business. So think about oops. Have you guys ever seen those little charts where it shows like, you know, all the different car brands, and it'll show, you know, Lexus, and they'll show that that's owned by Toyota, and it basically traces back to like 5 companies. So those 5 companies are called conglomerates. And so what these insurance companies do is their business model becomes a model of acquisition. So like one of my favorite ones, Mass Mutual, if you look at theirs, they're freaking killer. Like their financial solvency and just what they do with their money is insane. So Mass Mutual, they bought their competitor, MetLife. This was in like 2015 or 16. You guys know MetLife, they've got like Snoopy on the commercial and stuff. So they bought MetLife. At the time, MetLife was their largest competitor. So imagine like just like in the sea, right? Like big fish eating smaller fish. Okay, well, imagine a big fish eating a bigger fish. Like you're just building up the entire time. Like, man, I can't wait to sock it to these guys and just destroy them, take over all their business, acquire all their agents. That's what Mass Mutual did. So then they bought MetLife. Before that, they bought a company called Invesco, which was a mutual fund company. And if you look at their balance sheets, you see them in mortgages, you see them in commercial real estate, you see that they're involved in technology, and they acquire. They just buy companies. And what happens is these other companies have their own revenue, they have their own profit, they have their own numbers, and it boosts up the performance of the insurance company because they've got all this growth beneath them now. So they're adding new flows of income. It's no different than like Mike increasing income, saving, and then acquiring investments. Okay, but these are gigantic investments. So that's their conglomerate model. And then they do have very conservative investment practices. So if you look at, when you look at their balance sheets, you don't see a ton of aggressive investing. They're investing in things that they know are going to pay off. So like you're not going to pull up their balance sheet and see a bunch of cryptocurrency. Okay, they're not doing that. And if they own equities, they own equities the way Warren Buffett owns equities. They're buying 10% of Coca-Cola. They're buying large enough percentages of these companies where they're deal makers and they have some sway. They're not diversifying and buying a bunch of random stuff. So they're very conservative investors. They're going to make money no matter what on their investments. And here's the deal. The promise is only as good as the one making the promise. So if you look at, all right, we guarantee you're going to make money, the government can guarantee you're going to make money too. And so can a bank. Like so many different organizations can do that. But ultimately it comes down to how strong is the one backing the promise. Okay, because I could get an official document from the government that says I'm going to guarantee that I make money for you. But if Nano knows I'm broke, it doesn't matter what the document says, right? You're like, dude, I've seen like you don't have money. That's not actually going to happen for me, no matter what that paper says. So, and then the last one is you are guaranteed to always make money because you still earn dividends while you are using your money. So in the most literal sense of the when you pull your money out of your account, you're still earning dividends. And I like to illustrate like this. All right, so let's say this is a timeline and you have $1 in your account and this is year 1. All right, now you know that every single year, this dollar is going to earn 6 cents. That's going to happen in year 2. That's going to happen in year 3, 4, 5, and so on all the way down the line. All right. Now, if you have the money in the account, you're going to earn 6 cents on the dollar. Now, if you pulled this dollar out of the account, you still earn the 6 cents. Okay. So 6 times 5, that's 30 cents. That means that by year 5, you have $1.30, even though you took the money out. Mike, if you knew that was the case, how many times would you take the money out?
Every time.
Every time. All day, every day. And if you pay it back, you have even higher profit because you're paying off the interest early. So based on that, how many times would you pay it back? As quickly as possible. It's monetary velocity. How can I take the money out as soon as possible, pay it back as fast as possible, and continue to do that over and over and over? And I just take advantage of this growth on my money. Meanwhile, I'm acquiring assets. So Mike, if you knew that you could do this and you could go make 12% over here simultaneously, how many times would you do that deal? Every time. That's how the sacred account works. For those of you that have been like, how does this thing play out? How does it work? That's how it functions. So that's how we can guarantee you're going to make money, is this thing will still earn money when you take the money out as if you never took the money out. Imagine a bank that's going to pay you 6% whether you put money in or don't. If you took your money out, they still credit you the interest. Like if that happened to me in my bank, I would be super shocked. I would probably let them know so they didn't try and fine me or charge me fees for some mistake that they made. But that's how the sacred account works. Now, here's some stuff I want to hit. This just goes back to show you again the strength of these companies. So this one I found, it only goes back to 1978. So we're going to use this as our example. So in 1978, we can see the dividend performance of Mass Mutual. Okay, and this goes all the way to 2017. All right, so we can see we've talked about 6 to 8, right in that range the entire time. In the 80s, because interest rates were high, these guys were paying 12, 11, 10 throughout that entire period. Tax-free, so 12 tax-free is more like 13 or 14, or maybe even 15, depending on your tax bracket. Okay, and as interest rates started going down, we see that the dividends, still stay within that 6 to 8, but they taper back off to where they started at. And so we can actually look at the track record and see that's what they've paid. Okay, do you think if you went to a bank, do you think your bank even wants to show you historically what they've paid in interest? No, what are you going to see? You're going to see 10s and 12s in the 80s, all the way down till today where they pay you 0.01. They would be ashamed of that. I remember when I first learned the rule of 72, and it goes like this. So if you guys have not learned this, I'm going to teach you really quick. The rule of 72 means if you take the amount of money that the rate of return you're earning, and you divide that into the number 72, that tells you how long it takes your money to double. So if we have a 12% rate of return, and we divide that by 72, 72 divided by 12 is 6. So that means that my money is going to double every 6 years. Right? If I'm earning 6%, that's going to be every 12 years. So I remember when I first learned this, I called my bank and I was like, hey, what's my interest rate? And they're like, well, it's right now it's 0.01. And the lady, she was just the bank teller. She didn't know what was going on with it. Her job was just to sell savings accounts. And she's like, well, yeah, I mean, the economy, it has been pretty bad. And I was like, no, just tell me the savings rate. What are you guys paying me on my money? She's like, 0.01. So I was like, okay, well, what's 72 divided by 0.01? Okay, and then I realized I did the decimal wrong. 0.01 is 1%. She said 0.01%, not 1%. So it's really 72 divided by 0.001. Oops. Divided by 0.001. 72,000 years was how long it would take my money to double. I didn't know any better. So on the phone, I told her that math. I was like, so you're telling me it's going to take 72,000 years to double my money? And that's when she was like, well, the economy has been really bad. So guys, that's the rule of 72. And you have to look at that, and again, how long is it taking you to double your money? In the example we just showed with Mike, if Mike can invest at 12%, simultaneously earn 6 on his account, his money doubles that much faster. Okay, so that's what we're looking at there. This next one is same. It's Guardian. Guardian is showing from 1976 through 2015. Sorry, 2017. Same deal. Okay, Guardian, they show their minimum 4% as well. But they're showing, again, the same thing. You can see, again, in the 80s and 90s, they had that peak, and then they taper back off. This last couple of years, they've been right around 6%, 5.5% in that range. Okay, so that's Guardian. So we can see that the consistency has been there. And again, the guarantee is only as good as the guarantor. Okay. Now, the third one we have here is never pay taxes. we can guarantee you will never pay taxes. This comes from section 7702 of the Internal Revenue Code. It protects cash value from taxation. Literally, it's written into the IRS code. So there's not like we changed our minds and we're going to tax it. Like, you signed a unilateral contract. The IRS has no control over it. So there's not this can't be a traditional IRA that they mandated and they control. This is a publicly sold product that they have nothing to do with. And at the point you issue the policy, you're the only one that can make changes on it. Okay, that's part of the insurance benefit. Now, policy loans are another thing that prevents you from ever paying taxes. So if you have money in an account and it's earning 6%, logically, Lexi, if you pulled that money out and you earned 6%, what would you think about taxes? You'd be like, I'd have to pay, right? Mm-hmm. So check this out. If you had 6%, yeah, you'd have to pay, but what if you never actually withdrew the money? And what I mean by that is, with a life insurance policy, you borrow the money. The reason why is the IRS can't tax a loan. Now, people are like, why would I pay interest? Do you guys realize this is what Apple does? People are pissed because Apple's overseas with all their stuff. The reason they're overseas is they don't want to pay income tax. They don't want to pay capital gains tax. So they'll park all of their money overseas where the taxes are going to be lower. And when they need money in the US, they just borrow it from the bank. They would rather pay the piddly amounts of interest than the taxes they'd pay to bring the money back to our country. So when you study the top 1% of wealth, this is the way they operate. Wealthy people do this as well. They'll stick money in a bank or in an investment, and then they'll borrow against the investment because they don't want to pay the taxes on the money. That's how smart people invest. They're not concerned about interest. They're concerned about taxes. So they understand taxes are interest. Now, a policy loan, check this out. This one I used to actually use when I used to teach. I was in an insurance company where we taught whole life was the devil. We were Dave Ramsey guys. And so we would be like, man, you never want to buy whole life. And the reason why is you don't even actually earn a dividend. Your dividend is just a return of your premium. So we'd be like, they just overcharge you for the insurance and give you your money back. And that was the thing that we would tell people to get them to cancel their whole life insurance policies, is you're not even earning real dividends. And it's even in the taxes. Like when you look at the tax forms, it talks about how a dividend is simply just a return of premium. Okay. Now check this out. It is classified as a return of premium. Now the problem is the mindset behind it's just them giving your own money back. How do you justify that when they start paying you more in dividends than you ever actually put into the policy? I like that it's classified as a return of premium. They're giving me more money than I ever gave them, and the IRS won't ever tax those dividends because they classified it as a return of premium. Now, technically, a dividend in anything is a return of your money. If you invested in Apple, the reason a dividend comes from Apple is they asked you for X amount per share. They didn't need it, and they gave it back to you. Now, if you did that with Apple, we'll just call that return of iPhone. They would tax it. So for whatever reason, the IRS decided with insurance companies, that's not how it's going to work. It's still the same as a dividend in any other investment. You gave them money. They were more profitable than they thought, and they paid you the profit in the form of a dividend. In this case, you gave them premiums. They did a better job with those premiums than they expected. They gave you a dividend as a premium as part of that profit. If I'm an Apple investor, I gave them money for a share. They performed better than expected. They gave me a part of that money back in the form of a dividend. Now, just like any investment, if I buy a real estate deal, let's say it's $100,000 of my own money that I put into it, that's going to pay me cash flow. I still want the cash flow. I could look at it and say, well, I put in $100,000 and until I made $100,000 in cash flow, I haven't made anything. But we all know that's not the case. I'm going to make more than I put into it. So with this, the reason why you never pay taxes is simply because of the way it's classified. For whatever reason, they decided since it's a return of premium, they're not going to pay taxes on it, even when you pass the point of the money you've given them. I gave them 10 grand. They've paid me 100. For whatever reason, the 100 is not taxable because it's a return of premiums, even though I never gave them 100 in premiums. So this is really like a cool thing. The next thing is the Neckline. So there's something called the Neckline, and that's basically, we go back to this previous slide. In the 80s, Nano, if you were alive in the 80s, well, you were alive, an adult. Let's say you were an adult in the 80s, and you had some money. And you knew you could get 10 to 12% tax-free and there was no limit on how much money you could put in that, how much money would you put in that?
Borrow to put the money in there.
So that's what people were doing, is they were putting literally all of their money into this. Wealthy people would stick every cent they had into a life insurance policy because they knew they would make 12% tax-free and that the IRS would never touch that money again. So you guys think the IRS was cool with that? No, they got pissed. So they created what's called the Neckline, and they basically said, we're going to put a threshold of contribution on your sacred account. You cannot put more than this. Now, the IRS, they're genius in the way that they've figured out how to override the entire country with taxes, but they're dumbasses when it comes to writing their own policies. So they tied the Neckline to the death benefit. So if I have a contribution limit, the way that I get more in contribution limit is I just increase my death benefit. So even the Neckline, which could make your policy taxable, pretty much we can manipulate that anytime we need to by adding term insurance. We can buy like stinky little cheap term life insurance, stick like $500,000 of it, and your MEC limit just shot up. And it only costed you like $20 a month to do that. So that's what we do here is we increase the Neckline to make sure that you still never pay taxes, even though you're putting more money into the policy. Now, the last promise we make, and I'm going to start to wrap up here, is you will leave a legacy no matter what. Okay, with your 401k, we can't guarantee you're going to leave a legacy. With your real estate, we cannot guarantee you're going to leave a legacy. With the sacred account, you will leave a legacy because it has life insurance. Okay, now, Nano, you've seen some of the illustrations. There's always like way more death benefit than there ever is cash value, huh? So when you die, your beneficiaries do not get the living value or the cash value. They get the death value or the death benefit. The death benefit is typically like 2 to 3 times more than what you actually ever had in the account. Which means if you couldn't get to the end zone and you couldn't hit your target for your family, your sacred account is going to guarantee that it happens for you, no matter what. Not only that, the money that your sacred account pays your family will never be taxed. It's income tax free. They will get it tax free and they'll be able to use that money forever. So when you think about like there's a living value on a policy, which makes sense. If I had a 401k or a bank account, that's the money I have when I'm alive. Mike, if you signed up for a bank and you're like, all right, so I'm gonna give you guys 100,000, and they're like, cool. If you die though, we're gonna give your beneficiaries 200,000. You'd feel pretty good about the bank, right? So that's the sacred account. That's what it does. So that's how it guarantees that you leave a legacy. Now, some people like they'll look at this and be like, well, you don't get your cash value. Like you were never like when you're alive, understand this. When you're alive, the death benefit is not real. You're not going to get it because you're not dead. Just like when you're dead, you're not alive. So you don't get the cash value, you get the death benefit. It's two separate things. Like when you're sleeping, you can't be awake. That's just how life works. Okay, so you have the death benefit, which is the valuation of your policy when you're dead. You have the cash value, which is the valuation of your policy when you're living. When you're living, it would make sense that you use the living values. When you're dead, it would make sense that you use the dead values. The dead values will be more than the living values because it has life insurance and it's going to leave a legacy for your family no matter what. Now, here's the deal. The death benefits received tax-free. It's received no matter what, and it only gets larger with time. Okay, because it's whole life insurance, it grows, and your premium doesn't grow, just the death benefit does. It goes up in value. And so basically what that means is your death benefit grows over time just like your cash value does. We used to sell term insurance. The problem with term insurance, and I sold Mike term insurance, which I told him to cancel as soon as we got the sacred account, right? When Mike buys 100,000 of term insurance on a 20-year term, in 20 years, do you really still have 100K? No. So Mike's screwing his family over because the insurance did not go up in value. It's level term. It didn't increase. So Mike's looking at, all right, well, if this thing is really supposed to provide for my family, how is it going to do that when it's only going to be worth 30 grand in buying power by the time they actually use it, if they actually use it? Did you know on term life insurance policies, a death benefit is only ever paid 2% of the time? Because the insured never dies when the policy is in force. It's too short a time period. That's why they underwrite term so hard, is they know they're not going to have to pay anything. So the margins they make on term insurance are gigantic versus the margins they make on whole life, like really aren't that gigantic because they know you're going to use the cash value while you're living, and then they're going to have to pay out this gigantic death benefit no matter what.
And by the time that you actually need to use it, it's too expensive to pay for.
Yeah.
Old people can't afford term insurance.
Mhm.
So that's really like how we keep it, in the legacy. And then through a trust, actually, you can even control how the death benefit's used. So if you're like, I don't want to just leave my family $1 million, leave a trust $1 million and then write your trust provisions so that your family has to abide by the provisions. So they can't just waste that death benefit. So you could literally say, unless you go see Wealth Dynamics, you cannot access the death benefit. They've already got a plan put together for you. You've got to do what the plan says. Otherwise, this thing's off limits. So you could write that into your trust. Now, here's the nice thing with our sacred account companies, our top ones, they've paid a death claim 99% of the time, which means when a claim is filed, 99% of the time they pay. Okay, that 1% time, that's like suicide exclusions, like things where it's not legit. So if you think about from a solvency standpoint, when a claim is legitimate and it's filed, it's paid. The only time it's not paid is if it's illegitimate. So like most policies, if you're within the first 2 years and you commit suicide, death benefit's not going to get paid. Some policies, if you die committing a crime, they're not going to pay. So you've got to understand when they pay out, when they don't. But when it's legitimate, 99% of the time. Okay. Now, I'm going to hit some real quick numbers so you guys understand who we're dealing with here. So the first company I'm going to give you some stats on is Mass Mutual. Okay. So Mass Mutual, they were established in 1851. Okay. They've had 151 years of consecutive dividend payments. That's in a row. The 2019 dividend is 6.4%. Again, that's tax-free. And in total dividend payouts this year, they are paying out $1.72 billion in dividends. That's billion with a B. Now, we had a competitor one time, it was probably 6 months ago. And I was working with a client and he's like, oh, those insurance companies, they advertise the dividend. They never actually pay anything. It's a scam. And so we just pulled up, literally is the easiest objection in the world to overcome. We just pulled up what did they pay last year? And I'm like, Mark, they paid 1.7 billion. Does that look like a scam? No, they actually paid that money out. Now, Mass Mutual, they have $265 billion in total assets. Okay, so that's reserves, that's real estate, that's investments, that's total holdings. $265 billion. Over $39 billion in annual revenue last year. That's like some serious money. And they're number 84 on the Fortune 500 list. They've been on the Fortune 500 list for 25 years in a row. So we're not dealing with like I said, small cap, aggressive growth, like hoping and speculating. These guys have been killing the market so like forever. I'm actually reading Sam Walton's book right now. It's called Made in America. When Walmart was about to go public, the reason why is he was having to take out all these loans to expand. So he couldn't get anyone to loan him more money. So the last company he took a loan from was Mass Mutual. So if Walmart did not go to Mass Mutual to take a loan, Mass Mutual, or if they didn't give them that loan, Walmart wouldn't be what it is today. Okay, now Mass Mutual, like I said, they're straight up thugs with investing. They kill it. So it was $1 million they loaned him. They didn't just loan him the million, they asked for stock options. So that way, when he went public, because they knew he was going to, they made millions and millions of dollars in shares because they had ownership in the company. Okay, so Mass, like they are savages. If you Google, they recently sold Invesco, or they sold Oppenheimer to Invesco. If you Google that deal, they killed it with that Oppenheimer deal. Now, the next one here is Guardian Life. Guardian, they've been around since 1860. They have 151 years of consecutive dividend payments as well. Their 2019 dividend was 5.85%. Total payout was $9.78 million, so just under $1 billion. They have $74 billion in assets, over $13 billion in revenue. They're 244 on the Fortune 500. Now, you guys might look at with Mass and Guardian, like if it was a contest, Mass kind of wins with numbers, right? The problem with Mass and the benefit of Guardian is Mass knows they're big. And so because of that, they're very difficult for you to get them to do anything like creative or different. Their business model is like think of McDonald's. If you went to McDonald's and asked them to make you a special item on the menu, they're going to do it? No, they're going to be like, that's not what we do, bro. But if you go to like a smaller shop, you go to like, Arctic Roadrunner, or you go to like whatever else we got in town here, they probably would. So Guardian is more flexible. Guardian will let you lower contributions and increase contributions Mass won't, because Mass is like, dude, we're the biggest. We don't have to. At the end of the day, we run the country, we run the town. If you don't like it, you can go to a different carrier. That's kind of their attitude. Okay. So with Guardian, they're like, hey, we want your business. We're still giant, but we're going to be flexible and let you do more because we know that the other companies won't allow you to. So just because the numbers are lower, like at a certain threshold, it doesn't matter anymore. Like if you've got $1 billion, you've got $1 billion, whether it was just under $1 billion or whether it was 1.7, like you're doing well at that point. So that's Guardian. The next one here is New York Life. They were established in 1845. They had 175 years of consecutive dividend payments. In 2019, their dividend was 6%. Total dividend payout was $1.8 billion. They have $311 billion in assets, over $43 billion in revenue. They're 71 on the Fortune 500. And again, they've been there 25 years in a row as well. So again, these are giant players. All right. Now the screen I'm going to show you guys next. You guys ready to have some fun?
Yeah.
All right. So Mike, remember these numbers. So we have 311 billion, 74 billion, 265 billion. Okay. Now, really quickly, before we do this, I want you guys, from a financial sense, when I say the name of the country, Iran, what do you guys think of? Oil. You think poor? War. Oil. What do you think of? Money. They've got money, they've got oil, they've got nukes. All right. So just think of that. All right. So these are countries, and this is basically their total assets in billions. All right. So what was New York Life?
311.
So if they wanted to, they could acquire Vietnam.
I wouldn't.
Okay. Or they've got, I wouldn't. They could buy, I mean, they got pho over there, Mike. They got so much pho. They got Kuwait they could buy Iran, they could buy Iraq, Qatar, Bangladesh, Morocco, Libya, Algeria. So these companies that we're looking at are bigger than some of the national countries around the world. In asset value, our sacred account companies could acquire countries like Vietnam and Iraq. All right. You go all the way down. We got Egypt, Luxembourg, Slovakia, Oman, Lebanon, Nigeria, Iceland, Bulgaria, Slovenia, Angola, Uruguay, Cyprus, Sri Lanka, Panama, Serbia, Jordan, Kazakhstan, El Salvador, Estonia, Honduras, Kenya, Lithuania, Ukraine, Latvia, Myanmar, Azerbaijan, Georgia, Malta, Bolivia, Bahrain, Bosnia and Herzegovina. That sounds rather inappropriate. Paraguay, Albania, Turkmenistan. So those are all countries that we could, like, our companies literally could just go buy those. Think about that. Like people that live in Iraq and Iran, they probably have some sort of patriotic spirit. Like, man, our country's awesome. Like, imagine living in the US and knowing that there was a publicly traded company that could just buy you if they felt like it. Now, politically, they probably aren't allowed to do that, but financially, like if they could, and they wanted to, they would be able to. Like, the math works. Isn't that crazy? So we've got a lot of financial strength here, and that's the point that I'm making tonight. Okay, so that's really where I want to hit. And again, just real quick recap, real quick refreshes. So the promises here are, number one, you will never lose money in the account. Okay, the reason why is these are the guys that are backing the accounts. The promise is only as good as the company making the promise. All right. Number two, you will always make money. Okay, again, this is coming from our dividend payouts. Historically, these have happened for over a century and a half. Number three, you will never be taxed. Again, it's because of Section 7702 in the Internal Revenue Code. It's also because of the fact that for whatever reason, the IRS treats dividends as a return of premium, even though they're more profitable than what you've contributed. And then number four, you will have a legacy no matter what, because you have that death benefit. If you pass away, you have beneficiaries, they will get the policy, and they'll get more than you ever had saved. So guys, that's what I want to wrap up on tonight. That's the sacred account. Those are the four promises. You cannot get those promises from real estate. You cannot get those promises from the stock market, gold, silver, any of that stuff. It only happens with the sacred account. All right. Do we have any questions to wrap up on?
Well, Virgil, I think he'd asked, I think he jumped in about halfway through. He was asking about what the high early cash value was, the whole life.
High early cash value?
Yeah.
Yeah.
Explain.
So
he understood what whole life is, but he didn't understand the concept of it.
basically with whole life insurance, you have, I don't want to get too nerdy on here. Let's say you have, you know, $1 that you're going to put into a policy. You have what's called a base premium. And then you have what's called cash value. Now, most people are not aware the agent can actually choose how much money goes to the base premium and how much money goes to the cash value. Okay. So on the base premium, most agents are going to make 50 to 80% of whatever goes into it. On the cash value, they might make 1 to 2% of whatever goes into it. So Nano, if you were not an ethical guy and the client didn't know, which one would you pick?
Scumbag, you know, that will benefit me the most.
Base premium. So most agents sell a whole life policy with no cash value, only base premium. So if you guys have ever seen a whole life policy where it's 0 cash value for like the first 5 years, and then it grows and it takes like 15 years to break even, that's because the agent's either dumb or they're a scumbag. They're uneducated, they don't know better, or they're a scumbag. So a high early cash value basically means that we take, the money in the policy that we're putting into it, and we structure it to where the majority of that money goes to cash value. We actually try and minimize the base premium. So you want to minimize the base premium to like 70 to 95% going to cash value. That would leave maybe 30 to maybe down to 5% going towards your base premium. So very little money goes. Now, the problem with this is you just eliminated the commission, and the agent makes almost nothing to sell that policy. So unless you have a very high volume or you have other products and services to supplement, most companies won't do this model because it doesn't make them enough money. Okay. Like we have companies just in town here, New York Life, one of our competitors. That's why we acquired their product to sell. They could sell sacred accounts. They just choose not to. They understand they make significantly less money to do it that way, so they won't do it. They have one of the best dividend rates in the world, financially strong company. They have everything lined up. They just won't write it. So we brought them in because we're like, this could help people. If we bring it in, we can do it the right way, the way that they're not willing to, and actually give the client a good deal, even though we get paid less. Okay. So Virgil, that's the base premium, the high early cash value. The agent can literally customize how much money goes into the cash value to where that policy is able to be used for investing rather than just being life insurance. Do we have any other questions here?
I think that's it.
Is that it?
One question.
Awesome. Well, guys, thank you for watching and thank you for tuning in again. We'll be back next Friday, 6 p.m. Alaska time. Again, that's 9 Central, 10 Eastern. Make sure if this video helped you real quick, make sure you like, you share, and you subscribe. Oh, and give us a Google review. Okay, we had someone go, we have so many. We had a hater go on there last week and tell us they were all fake. And we just got like 10 more after that. So go on, give us a Google review if this helped you. And make sure that you let us know you're real so that we don't have people saying you're a fake person giving us fake Google reviews. We appreciate it. Have a great Friday night.